Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. We record this show live every Tuesday to help you learn the ins and outs of passive real estate so you can go into your next first or actually next deal with confidence. So if you haven't done so already, make sure to check out passiveinvestingwithwhitney.com. There, we've got some free goodies for you. As well as, you can book time on my calendar to figure out, us have a discussion about all things passive real estate. Now, today we want to talk about elections, staying the course through elections. And moreover, like, how do elections actually impact passive real estate in general? Okay. Now, we are not going to get into politics today. Okay. So if somebody is here like wanting to have like a political conversation, that's not what today is about. Today is about what you can do as a passive real estate investor. How can you empower yourself to navigate what the conversation that's happening in the environment today? Now, before we dive into today's topic, if this is the first time we're meeting, welcome. My name is Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And this is the whole reason why I invest passively in real estate. I started off 2002, living, flipping, and house hacking, and then eventually transitioned into scaling a sizable real estate portfolio through single family rentals, and then bought multifamily, and then got into syndicating multifamily assets. And anyways, that was all my active endeavors. Okay. I was very active with my time. Now, at some point in time, we had a baby girl. We had I'm still working full time. I'm taking care of family. And I just want to be able to travel. I want to be able to spend time with them. COVID hit. I want to be able to be at home with my family. And what allowed me to do that was not my active endeavors. It was not the single family rental portfolio. It wasn't even the multifamily buildings. What allowed me to do this was my passive real estate portfolio. And so I took a lot of my active holdings, all that active income that was coming in, and socked it away methodically into passive investments and scaled a passive investing portfolio that rivals my actual active holdings. And so today, my husband and I, we hold over 6,500 multifamily units, both actively and passively, 2,200 self-storage units, 15 express car washes. But really what you're after and what we were after was having that 100% control and choice on how we spend our time. And we can help you do that here at passiveinvesting.com. We can do it through our debt holdings. We have we've lent over $331 million through our rehab wallet lending arm. That's in fix and flip single family real estate. Okay, that aligns very well with what's happening in the market today, especially if you're listening to this in September 2024. And then we also have our equity holdings too. Now, again, we shouldn't be getting into any math, tax, or legal advice, okay? But if we do, especially in our open Q&A session here at the end of the show, make sure to consult with your investment team before making any investment decisions. Now, I wanted to kick off today with just kind of like a little bit of background, on, when we're looking at the election environment. I mean, again, we're recording this at September 2024. The number one question I think most investors are asking is what's going to happen? No matter the outcome of the election in November, how is this going to impact my holdings? How is it going to impact the market? How can I get ahead of everything? But in order for us to learn, we actually have to take a historical look backwards and look at the historical behavior of the markets during election cycles. Now, there's, tons of research that I'm going to mention, throughout today. I really encourage you to look at this, these reports. But Vanguard did a study that basically showed that historically election cycles have had no long-term impact on the stock market performance. Now, we are primarily invested in rental real estate, which actually cycles differently than the stock market and actually has a longer a longer term view than the stock market does. Okay, now they looked at this data all the way back to 1860 to the present and essentially found no correlation between presidential elections and actual market returns. And a similar result was found in S&P Global research that found that markets tend to experience heightened volatility right around the election, okay? But this is typically short-term sighted and often driven by investor sentiment than actually the economic fundamentals that are literally occurring in the market. So, all right, so let's kind of tease apart, some of those key trends that could be impacted by the elections. Okay, and then we'll get into some of the short-term reactionary, things to keep on your eye on for the short term, and then also look at the long-term behavior of the markets. Now, there are key trends that are definitely affected by elections. And we can put those generally in three buckets. It's going to be interest rates and inflation, government spending, and taxes. Now, here's the through line through everything. Contrary, and this is, I tried so hard to find a clear delineation case. Interest rates and inflation, government spending, and taxes, okay, these all can go, there's really no correlation between parties and what really happens here. So what we generally are being told may not actually line up with what happens in Congress. Okay, surprise, guys, it may not actually line up. So interest rates and inflation, the election can influence monetary policies, because whatever party takes over the government, be it primarily in the legislative branch, they're going to be closer to impacting fiscal policy than anything. Okay, now this might have a tilt towards government spending, tax cuts. These are just things, for example, both of which can put an upward pressure on inflation. Guys, we've experienced this for the past couple years. But these things are long-term movers. It's not just like, overnight, something happens and then like the next day we can attribute that that's, what the interest rates, increase was and what the inflation increase was. Okay, so there's not these economic key trends in economics actually take years to play out into the system. And guys, don't forget the Fed. Okay, the Fed in all this actually can manipulate how interest rates and inflation affect the economy, which we've seen in the past couple of years as well. Okay, so my take home here is, in all my research, things tend to be more slower moving than what we would like to attribute to them and, attribute to a particular election cycle. Then we got another key trend that it's influenced by elections is government spending, okay? Both political platforms, both political parties are going to differ on how they spend government funds. Now, a study by the National Bureau of Economic Research highlights that different administrations actually, where they differ the most is in two key sectors. And we're actually going to go over three here on my next slide, but it's typically around defense and infrastructure. Those are the two of the three key sectors we want to keep our eyes on here. Now, taxes, that's another key trend that's influenced by election. Tax policy, is where an election can really impact the tax policy over time, okay? And these policies generally are going to be driven at either policy for middle class or policy for corporations, okay? So, ideally, we're trying to, figure out if there are going to be tax cuts for the middle class or tax cuts for the corporation. But that's another key area that elections impact. Now, remember, we already touched on two key sectors that are really influenced by elections, and that's infrastructure and defense. The third one is actually energy. And now this is substantiated by research. There's another policy paper out there by Goldman Sachs that, really says that, when everything told, looking historically back across elections, these are the three key sectors that if you're invested in, that probably the election is going to have a significant impact on, okay? Notice here, what we don't see is actually real estate, okay, or residential real estate, okay, or businesses, okay? But if you're invested in the healthcare sector, defense sector, energy sector, yes, there, the outcome of election could have a very short-term impact and, quite honestly, heightened impact on your investment. And like, why? Let's pick into this. So the healthcare sector, according to research by Fidelity Investments, is one of the most reactive sectors to the election cycle, especially when there's changes in healthcare policy at stake. Okay. For example, like in the 2010 Affordable Care Act debates. Okay. Defense sector, according to Morningstar research, shows that defense stocks respond positively to election outcomes that in favor increased military spending. Okay, so again, pay attention to, if this is an area that you're invested in, and you are, looking at a candidate, if they're really heavy into investing into defense and military spending, that's where they're going to put their dollars. You might have some alignment here, okay? And conversely, if defense spending is cut, okay, military spending is cut, that sector is also impacted as well. And then we got the energy sector. So this is going to be oil, gas, but don't forget about our renewables like solar and wind. Okay. Typically oil and gas has been, tied to like Republican Party administrations, solar and wind tied to Democratic policies promoting green energy. But we're starting to see kind of a blur of this line with recent administrations. Okay. But that right now, like historically looking back, that sector has been tied closely to an election as well. Now, we took a look at historical, essentially the take-home message is in the title of the presentation, Staying the Course, okay? The title of this presentation wasn't like, how do we move our assets into the top 3 sectors that could benefit from this election, okay? Very different title. So it's really about staying the course. But we're humans and we react to our environment, okay? Now, some of us are better at like not moving chess pieces than others that may have come from experience. But let's talk about the short-term thinking versus the long-term reactions. Okay, in short-term election volatility, it is very real. Okay, it is generally going to happen, every election cycle year, and essentially we're going to get election-driven uncertainty. We're going to have fear-based markets and movements, but this is largely driven by media and investor sentiment than actually true economic fundamentals, okay, as the research demonstrates to us. Here's 2 other studies that we can take a look at. JP Morgan Asset Management conducted a research showing that U.S. stock markets often experience increased volatility during the election years due to uncertainty, especially in the few months leading up to the election cycle. Guys, if you're a stock investor and you've been investing in the stock market for years, you know about the October bounce. Okay, so the election cycle comes right after the historic October bounce. So we see even increased volatility during this time. But these volatility trends tend to be very short-lived and driven by investor sentiment, not actually the long-term economic view. And this is also substantiated by other studies, an LPL financial study, as well as SP Global and BlackRock. What's key to understand, in the LPL financial study, that essentially the election volatility here in their study settles down 82% of the time within the Q4 of that year. So essentially by December 31st of that election year, the volatility is settled. We're getting back to normal business. All right. So let's take a look at long-term reactions. Oh, and I just wanted to, draw some distinctions on this graph. What you're seeing here if you're watching on YouTube, you can see this is a 5-year outlook at the S&P 500. It's bouncing all over the place. Okay, that could probably give any investor a little bit of a stomach turn. But when we correlate that to looking at, say, the S&P 500 since 1940, we can say, yes, it bounces around, but there's a clear trend. If you hold on, okay, and you don't react to short-term thinking, the market generally goes up and to the right. Why is this? Because our market to date has been very historically resilient. And it's, largely research is showing independent of election results. And this is key because, investors should be focused on the actual economic fundamentals, not on headlines. Okay, and this is backed up by research by Vanguard, that looked at elections going back to 1960, as well as fund advisors that looked at the correlation of elections and stock market cycles going back to 1926. And similar studies have been produced by Fidelity and Morningstar. Okay. Case want to draw your attention to the fund advisors, or dimensional fund advisors. They say their data suggests that staying invested through the election cycle yields better results than trying to time the market. So in a couple investment groups that I'm a member of, several people I'm seeing are pulling their money out of the market, sitting on the sidelines, and now are going to try to time the market on when to get back in. So research actually shows us that the investor that stays invested in the market through the entire election cycle fares better than the person who pulls out their cash and tries to time the market. Okay. What's the take-home message of today's presentation? Essentially, stay the course. Okay. You're walking a road as an investor. There's going to be ups and downs, left turns, right turns. Okay. Some of these are actually real market fundamentals that are occurring in the economic environment. Oftentimes, it's just headlines that are, being put out there to sell news, to sell a reaction. Okay. So how can you block the noise then as we approach the election? Okay, how can you remain centered and move through this election cycle from a place of strength? Well, first step is focus on the market signals, okay, the actual data, not the headlines. So I'm constantly pointing out investors that I speak with, I'm like, be careful on where you get your news, especially if it's tied to social media. Okay. We always want to, in our household, I'm always teaching my daughter, like, trust but verify. Okay. So you see something from a reputable source, okay, yes, trust it. I mean, until it is proven not to be trustworthy, but always go out, find that original research and verify those data points for yourself, okay? So if that's the case, if we're to trust but verify, where is the original data, especially when it comes to residential real estate, businesses? Here are some of my favorite resources to tap into. Okay. Federal Reserve. Okay. We can go to Fred. We can go to the Bureau of Labor Statistics. We can go to the Census Bureau if we want to look at the actual original data sets. Okay, those can be a little overwhelming to try to interpret. So that's why I like kind of zooming out one step further, especially when it comes to residential real estate and looking at stars like sites like CoStar, Yardi. For the residential investor or the retail investor, you can look at compilation sites like citydata.com and niche.com. Those are two sites that I like. You can zoom out even further, one step further, and look at interpretations from people of that data. And that's where one of my favorite resources is Marcus and Millichamp. Johnny Chang is their lead economist there. He's great. And then also look for other economic, firms, kind of think tank firms. One of my favorite firms to follow is ITR Economics because they kind of walk a centrist road. They're not left, they're not right, they're right down the middle. Okay, so they tend to have like really no horse in the game, so to speak, horse in the race. And so they tend to give a really clear view of what's going on in the economy. Okay, but again, we got to tune out the noise. We got to make sure that we're looking at the actual data set. Okay, and then from there, use the data to make informed decisions and not media speculation. All right, guys. Now, just because we've talked everything today about staying the course through the election, okay, and not really trying to scramble and make last minute sales and trades, exit positions if you're in the stock market, or like last minute 1031 exchanges because you read a crazy headline that the 1031 exchange is going away in January. Trust me, I've seen that. A couple of people have passed those headlines on to me. There are investors out there that might want to take care and make adjustments to the strategy. But let's look at any rebalancing of the portfolio independent of an election cycle. Okay, let's make sure that it's coming from a strategy choice that is not attached to emotional response to any short-term political changes that might happen, and that you're looking at making sure that you're aligning your overall portfolio goals with your risk and timeline here. Now, I always look at the end of the year as an amazing time to look at my portfolio and just say, double check, are my goals still true? Is this the direction that I'm still pointing to grow? Am I still focused on, say, cash flow over equity growth? Okay, or has that flipped for one reason or another? Okay. And then when I come up with my strategy, the number one person that I consult with my strategy on January 1st is my tax professional, because I want to know any moves that I do that year that we're aligned, and that for on January 1st, 2025, that I am actually have conversed with them. I know the impact of any of the moves that I'm going to make. Maybe they have given me some tax strategy input of their own for me to optimize any exits, sales, trades, stuff like that. And then I have like a full calendar year to execute on that strategy. Guys, if you're here live, don't go anywhere. And if you're still here live, I welcome you to check out two resources. One, the book Money for Tomorrow that I published with Bigger Pockets, How to Build and Protect Generational Wealth. And then also I invite you to check out Passive Investing with Whitney.com. There we've got free resources for you. You and I can even hop on the phone to talk about your passive real estate strategy and how we can help you here at PassiveInvesting.com. Guys, if you're alive, don't go anywhere. We're going to start the Ask Me Anything part of our show. All right. Well, if a quick temperature check, you guys go over to the chat box or the Q&A box, and I want to know what you loved and what would you love to see in a presentation like this. This one was a challenging one for me. I wanted to provide with you guys with hardcore data and graphs and really tear apart the notion that election cycles are correlated with markets. And guess what? I got 85% of the way there. And then like the other 15% is like, yeah, there might be some, sectors that if you're invested in, you might want to consider to make some changes. Guys, and if you have questions, it can be anything related to this topic, or it can be other topics related to passive investing. I would love to answer those for you. Oh, can I put the QR code back up? Yes, give me just a second. There were two QR codes there, Andrew. One was for the book, one was for scheduling a time with me. I'll pop both of them back up there for you. Give me a second. So this is Passive Investing with Whitney.com. This is a subpage on the PassiveInvesting.com website. This is a great place if you want to get connected with me in my calendar and the free giveaway that I have on passive investing there. You can check that out. And then if you are interested on how to build a fortified financial foundation, and essentially, like I say, invest in by principle, not headlines. This is an amazing book. This is the book that I literally wrote for my daughter to teach her how to invest. And so thank you to Bigger Pockets to partnering with me on this and getting it out to the mass public. All right, let me exit these pages because I can't see people's questions without exiting here. All right, cool. Glad I got you taken care of there, Andrew. Do you think there are good opportunities in multifamily starting to come available? What assets are you excited about right now? I see, here's the thing. I'm excited about all parts of the market. I think multifamily hasn't gone away. So if you were on my presentation last week, and guys, I so apologize if you were here live. It was webinar difficulties all over the place. You guys know that, but we're in the part of the market cycles that's hyper supply or contraction, right? And that's all location dependent, right? We'd like to think that the market cycles the exact same across the United States. That's simply not true. Real estate is very hyper local. So some markets are starting to come out of the contraction period, and we're starting to see that, recovery and growth. Other parts of the market cycle, you might be going like, wow, we're going to be another year before our hyper supply is completely absorbed in the market. That's the contractionary period, then you'll start moving through recovery. So I say that because multifamily in the right market, it has been in a recovery scenario. Also in that presentation last week, I put up a graph to show you based on market cycles, what are the type of assets and that you should be looking at. And it's not necessarily invest in market. Multifamily is, invest today, go. No, it's like multifamily does well in any part of the market cycle. It's, all right, what type of multifamily are you buying? Are you buying distressed multifamily right now? And then here, like in 6, 10, 18 months, buying more value add multifamily. And then like 2 years past that, you're buying more class A, like buy and hold type multifamily, right? So you have to pair the strategy to the market, to the overall market in that particular area. So right now in the markets I like investing in, I think distressed assets, if you have the stomach for that, I think can be great. Tax debated can be another way of lowering your expenses on multifamily. And then, multifamily that has some sort of, value add edge to it. I'm not so keen still on the construction value add, but like, lease up value add. I think we're, in the next like 12 to 18 months, we're going to see hyper supply, and then a lot of the markets we're in be absorbed, and then we're off to the races. It's going to be rental competition. Rents, we're going to start escalating from there. Other assets that I'm really excited about today, debt. I think debt is an amazing asset to be in, but why? Because credit is still sucked out of the market, even though we saw the interest rate cuts last week. 50 basis points. Supposedly we're going to get another 1 to 2 rate cuts in the next 3 to 4 months, probably another one before the end of the year. Those rate increases and rate cuts take 6 to 9 months to trickle through the economy. So the rate cuts that we saw today probably are not going to materialize in the market until March. Okay. Now we're starting to see some of those rate cuts be baked into interest rates, but we're going to see future rate cuts, start affecting the market at a later date. So right now credit's still tight. That's why I still love debt. Debt's still a great opportunity. And there's still a lot of operators out there that are bringing on promissory note layers into their deals, bringing on private preferred equity layers into their deals. And if you believe in the operator, you believe in the market, and you believe in the deal, it is a very unique opportunity for you to get the bank's return, okay, and get for a lower position in the capital stack. Okay, those type of positions are going to start going away as bank lending comes back online. Those type of, preferred equity at 11 to 13% preferred return in 2 years is probably going to be pretty non-existent. Okay, it matches with the different parts of the investment cycle. So yes, we got debt, we got promissory notes, we've got preferred equity. If you're interested in any one of those, reach out to me for sure. What do previous elections tell us about which way the stock market economy may head depending on which party's president comes to office? See, that's the thing I'm trying to tell you is that the there's short-term things to look at, and then there's, but it's typically unhooked from the long-term view, the long-term reaction. So there are three key sectors. If you're in healthcare, defense, or energy, those are the three sectors that are tied closest to an election. Okay, so if you are like a diehard defense investor, which most people here are very much real estate investors. Okay, maybe you do have a little bit. I have a little bit of a defense position in my portfolio, but it makes up a very teeny sliver. I'm not really paying attention to it. Okay, so we want to take the long-term view, because it's those long-term economic changes, policy changes, government spending, taxes. Okay, what happens with inflation and interest rates. Those are the things that are going to play out longer term in the stock market. And quite honestly, we try to categorize things as red and blue, Democrat, Republican. To be honest, we've had inflation and interest rate increases under both types of administration, and pretty equally, honestly. So it's, we've had government spending increases under both administrations pretty equally, like if you go back and look at historical data. So we have to separate out the optics and what the headlines would like us to believe from what actually truly happens. Now, the one thing that I did find in my research that's pretty tied, especially since 1960, because to be clear, parties have kind of changed philosophies over time, but since about 1960, generally Republicans, the red, love cutting taxes for corporations. The Democrats tend to target actual middle class, the tax cuts for the actual private citizen. So that would be, those tax cuts could impact, things in the future, but not as much as we would like to think, long term, when it plays out in the long term. Thanks for the hint about ITR economics. I might follow the blog. Yeah, I love ITR economics. Again, for me, I wanted to have kind of a neutral view, as opposed to somebody who was trying to sell me a product or a program, or an investment. And really ITR was very separated from all of those type of goals. There's a lot of people that will say, hey, here's a political or an economist that you should follow. And then I click into it. I'm like, they're trying to sell me gold at the end of the day, or their course on gold. So it's not, that their platform is more marketing than it is true education. So ITR is kind of the best that I found. I do like Marcus and Millichamp. I do like Johnny Chang. He's been, if you go to the Best Ever conference, he's been there and presented live. He's another good person to follow. Speaking of debt as an asset class, at what stage of the economy will this fade for you? You mean if you mean in my portfolio? Never, to be quite honest, never. And I'll tell you why, because the way I structure my portfolio, and guys, this is my idea. This is what I do. Don't take this as gospel, and don't try to copy it, because we might have very different goals within timeline. Okay, is I want to sleep well at night. And so if I have a debt position in my portfolio that pays for everything, then I kind of have license to do more cash flow businesses, more private equity real estate, more other things with my portfolio, knowing that my debt position in all parts of the market, market cycle, are covering the roof on my head, the food over the table, the expenses, they're covering everything. So I will and to be honest with you, that debt position, somebody might go, oh, wow, for me, that would be 60% of my portfolio I would need to have in debt. For me, it's a much lower percentage, because I've been investing, for longer now. Somebody here might have, be, you know, $20 million, and they might only need like $1 million or $2 million invested in debt, small percentage of their portfolio in order to cover all their expenses. Like for me, it just gives me a license to play. But I harvest that income, and right now, because both my husband and I still choose to work, we just reinvest all that income to accelerate the growth of our portfolio. So, but at any point in time, I can flip that switch and retire. That's the beauty part of it. That's when you realize, hey, I am truly financially free. And you can do this through equity deals. It's just right now, cash flow is a lot thinner. And, you know, when I coach investors, especially if you're going to build largely through private equity real estate, you got to have a hefty buffer. Like your cash flow, you have to have like a 20 or 30% buffer in your cash flow. All right. Somebody posted, read your book, excellent information. Yes, hopefully you love that. You guys picked that up. Again, I wrote, the premise of the book was actually for my daughter. It was all the notes that I had for her to teach her how to build her own financial fortitude, fortified financial foundation, how to grow her money, how to keep her money. Most importantly, investors, we get really excited about growing our portfolio. And then we kind of like don't do as great at like keeping the money or learning how to pass it on like effectively. So those are skills that I wanted to make sure that she could, you know, build. You got to have all of that in your skills list. All right, guys. Any more questions? Drop them in the Q&A box. Otherwise, next week, we will be taking the week off. We are at our directors investor meeting with passiveinvesting.com next week. And then in first week in October, or I guess the second Tuesday in October, we'll be joined by Rob Gallo and Chad Zdenek. And then I will be back the third Tuesday of October with you guys. I'll hang out here for another minute. If anybody's got any questions, let me know. All right, guys, nothing's popping up in the chat box. All right, thank you so much for spending your time with me here today. Oh, we got a raised hand. Okay, I'll hang out and wait for your question. Oh, you're welcome. Somebody said thank you. Excellent. You're very welcome, Brian. Thank you so much. All right, guys, you take care, and we will be live here in 2 weeks, and I'll see you in 3. Take care.